Everyone's asking the same question right now. Should I buy SpaceX when it goes public? And that's a fair question, but it's also the wrong one. Because the more interesting opportunity isn't in SpaceX, but it's in what the SpaceX IPO does to the rest of the market. By the end of this video, you'll understand how SpaceX will affect you, whether you like it or not, and what actions to take to safeguard your investments. So here's the situation. 3 of the most valuable private companies in history are going public this year, as I'm sure you're very much aware of. SpaceX is targeting a $1.75 trillion valuation. It's aiming to list on Nasdaq in June. OpenAI is targeting Q4 at around $1 trillion, and Anthropic is planning an October debut. Combined, these 3 IPOs could raise over $240 billion in under 6 months. That would make 2026 the largest IPO wave in history. Now, the mainstream coverage is all about the hype, but we're going to focus on the mechanics, because that's where the actual insight is. Let's start with the most basic question. Can you actually invest in these companies? For SpaceX, yes, to an extent. SpaceX is doing something unusual. They're offering direct access to retail investors through Robinhood, Fidelity, and Charles Schwab. And retail buyers get shares at the same IPO price as institutional investors on day one. And you have to understand that almost never happens. Normally, retail investors get whatever's left over after the institutional investors, and they buy at a markup once trading opens. Elon Musk and his team says it's because they want to give back to the retail investors who've been with him all along. But it's actually not generosity. The strategy is deliberate. Musk's bet is that retail investors who are drawn to his companies, like Tesla, are less likely to sell quickly after the listing. They hold, which stabilizes the stock price post-IPO. It also gives Musk tighter control over who gets shares, rather than letting banks broadly distribute to institutional clients they choose. Here's the reality check though. Even with 30% of shares allocated to retail investors, which is 3 times the typical amount, allocations will be massively oversubscribed. Most people who apply won't get IPO price shares. The majority of retail investors will end up buying on the open market after trading begins at a premium to the IPO price. And how about OpenAI and Anthropic? Not there yet. Traditional access only, meaning retail buys after the fact at whatever price the market has already moved to. Now, this is the part I want to spend some time on because it's the most underreported angle of this whole story. Before SpaceX even filed its IPO paperwork, the company was quietly reaching out to major index providers, lobbying for faster entry into key stock indexes after listing. In March 2026, Nasdaq responded. They created what they call the Fast Entry rule. Under the old rules, even a company worth hundreds of billions of dollars had to wait at least 3 months, sometimes up to a year, before being eligible for inclusion in the Nasdaq 100. The new rule cuts that to 15 trading days. So, SpaceX chose Nasdaq over the New York Stock Exchange. Was the timing a coincidence? No, absolutely not. So, why does this matter to you as an investor? When a company joins the Nasdaq 100, every fund that tracks the index becomes a forced buyer. They have no choice. Their mandate is to hold the index, so they have to buy whatever enters it, whatever price it's trading at. Over 200 investment products with more than $600 billion in combined assets track the Nasdaq 100. That includes QQQ, one of the most popular ETFs in the world. So, within 15 trading days of SpaceX's IPO, all of that money is automatically buying SpaceX. You don't vote on it. If you hold QQQ or a Nasdaq-heavy index fund, or most 401k default options, you are now a SpaceX shareholder, whether you choose to be or not. Is that good or bad? Well, it's both. On the upside, that forced buying creates a structural price floor for SpaceX in the early weeks. There's guaranteed demand baked in. That's one reason the IPO is expected to pop. On the downside, research shows this kind of fast-track index inclusion allows newly public companies to raise about 6% more capital. And that extra capital comes at the expense of passive index investors. You're the buyer they're pricing against. And here's the part that should make you pause. Insiders, like Musk, early employees, early investors, have lockup periods before they can sell. Historically, that's 90 to 180 days. That lockup expiry lands right into the window when index funds are still forced buyers, which means insiders could be selling into artificial demand. A veteran Fidelity fund manager called the whole fast entry rule outright index manipulation. Now let's get to the actions you can take that I promised at the beginning of the video. How does all of this create a buying opportunity elsewhere? Here's the core mechanics. To buy $240 billion of new IPO stock, money has to come from somewhere. Funds don't conjure cash. They sell existing positions to fund new ones. At this scale, $240 billion leaving the market in 6 months, that selling pressure lands on specific stocks. And those stocks fall into 2 categories. The first category is proxy stocks. These are companies that investors bought specifically because they couldn't own SpaceX, OpenAI, or Anthropic directly. Now that the real thing is available, the proxy gets sold. Microsoft holds a large stake in OpenAI. SoftBank is effectively an AI holding vehicle with heavy OpenAI exposure. Both have been used as OpenAI proxies by institutional investors. Once OpenAI is directly investable, expect rotation out of both. NVIDIA is the picks and shovels AI play. It's benefited enormously from the AI build-out narrative. When pure-play AI stocks become directly available, some of that capital rotates. Rocket Lab is the only publicly listed pure-play competitor in launch vehicles. The moment SpaceX's S1 makes their full economics and market dominance public, that puts direct pressure on Rocket Lab's valuation. The second category is broad market collateral. JPMorgan modeled a scenario where if SpaceX achieves a large enough float, passive index funds could be forced to sell hundreds of billions of existing major tech positions just to rebalance their weightings. That hits the Magnificent Seven broadly, not because anything is wrong with those businesses, but because of mechanical rebalancing. Crypto also sits in the same risk-on liquidity pool as high-growth equities. When speculative capital moves toward IPO allocations, crypto historically feels it. Bitcoin, Ethereum, both are exposed to this rotation. And emerging markets may see temporary outflows as global capital tilts toward US listings. So is this a buying opportunity? Potentially yes. But 2 things to understand. First, the dip in proxy stocks isn't guaranteed to be deep or prolonged. If SpaceX's debut validates the AI growth story, it could actually lift the whole sector. The rotation risk is real, but so is the narrative tailwind. Second, the smarter entry point on the IPO stocks themselves is almost never day one. It's lockup period, 90 to 100 days after listing, when insiders can finally sell, and then the real price discovery happens. The IPO pop is engineered. The 6-month later price is where you actually learn what the market thinks these companies are worth. One more thing before the action items. Is SpaceX actually worth $1.75 trillion? Let's look at the numbers honestly. SpaceX reported $18.67 billion in revenue for 2025, with a $4.9 billion net loss. At a $1.75 trillion valuation, that's roughly 108 to 116 times trailing revenue. For context, Microsoft, Amazon, and Cisco all peaked somewhere between 30 and 45 times revenue during the dot-com bubble. SpaceX is being priced at more than double that peak. Meta generates $200 billion in revenue and currently trades at a lower valuation than SpaceX is targeting on $18 billion. Professor Aswath Damodaran, who is widely considered the dean of valuation, ran a Monte Carlo simulation and put fair value at around $1.2 trillion. That's 30% below the IPO target. He said he'd be reluctant to buy at that price, but would be interested closer to $1 trillion. The bull case is real, by the way. Starlink is a genuine monopoly-scale recurring revenue business. 10 million subscribers and growing. The launch business has no credible competitor at scale. But both things can be true. It can be a great business and still be overpriced. So here are the 4 action items. 1. Check what you already own. If you hold QQQ, VGT, or any Nasdaq heavy index funds, you are getting SpaceX exposure automatically, within weeks of each listing. This isn't optional, so know your position before it's chosen for you. Next, watch the proxy stocks. Microsoft, NVIDIA, SoftBank, Rocket Lab. If any of these pull back meaningfully in the June through October window, as capital rotates into the IPO wave, that may be one of the better entry points of the year on companies with real established fundamentals. Set your watch list now, not after the dip. 3. Don't chase the open market pop. Facebook's IPO, which was the most anticipated consumer tech offering of its era, closed flat on day one. If you don't get IPO price allocation, history says patience is almost always rewarded, so wait for the dust to settle. Lastly, set a calendar reminder for the lockup expiry dates. This is the one most retail investors skip. SpaceX prices June 11th, lists June 12th. Count 90 to 180 days forward. That window, September through December, is when insiders can finally sell. It's also when forced buying from index funds starts to fade. That combination is when you'll see what SpaceX actually trades at in a normal market. And same math applies to OpenAI and Anthropic. The IPO date is just the headline with buzz around it, and the actual signal of valuation will be the lockup expiry date.